Hello, this is Mark from TradeInform.com and welcome to this video on a profitable long-term stock index trading strategy. The trading strategy that I'm going to talk about in this video initially came about by me looking at the Zig Zag Indicator, and you may or may not have come across the Zig Zag Indicator. I'm going to bring it up, a chart here on the screen, and you can have a look at it. And you can see that the Zig Zag Indicator does a very nice job indeed of plotting the highs and the lows. I've set it here to 10% deviation, and so that every time we have a deviation of more than 10%, the indicator is going to pick out these highs and lows. It certainly looks fantastic, and you could think that if you wanted to trade some of these, you want to trade long here, short here, this is a brilliant indicator. However, it is unfortunately not an indicator you can trade from because it cheats a little bit. It uses information that is not available at the time. So when we see this low here, which the indicator has picked out so beautifully, unfortunately we would not know at the time that this is going to be the low. We have to know that we're going to have a deviation of greater than 10%, and that information just isn't available to us here. So we wouldn't know whether or not this is a low, and we wouldn't know whether or not to trade at this point. Okay, so it is nice in theory, and Elliott wave enthusiasts looking at the market may well get some nice use out of this. We can look at cyclical analysis of past behaviour. This is, quite a handy tool. However, I wanted to look at whether or not we could make this a valid indicator for a simple index trading strategy. So what I decided to look at was to take this idea of the deviation, but instead of using it to predict the past highs and lows, I wanted to say that if we're moving in one direction, it doesn't matter where we start, we're moving in this direction, we're going to continue to trade long until we have a deviation of 10% based on a close basis in the opposite direction. So instead of going up to this point, the high here, what we would do starting here is follow this along, and we'd still be long until we have a 10% deviation somewhere possibly around here, at which point we would reverse and we would go short. So at this point we'd take the profits from the long trade and we'd start going short. As you can see, we have a small movement short, however then the long trend takes over. As soon as we've moved 10% from the lowest close here, we'd reverse that position, take the loss and move on again in a long position. So how I've done this is I put it into a spreadsheet here, and this spreadsheet is based on the long short model, which is available on my website. And if you'd like more information about this, there is a link on the screen. And also, if you're interested in generally how to backtest using Excel, I do have an ebook available in the Amazon Kindle bookstore, and again there is a link on the screen to this. So I put it into the spreadsheet here. It doesn't matter, as I said before, whether we start with an uptrend or a downtrend. It's totally random. You can use whatever method you like to start it. But here we are, we're starting with a long trade here. And so the spreadsheet registers this as a long trade here. We're taking a loss here and we've moved short, gone down, and we're following this, and we're following this all the way along. The data that I'm using is the S&P 500, my favorite stock index for trading, and the data that I'm using is from 2000 to the present time, which is towards the end of October 2014. So I've got a results page here, and we can see how the strategy fared over this time period. Probably just have a look immediately over here at the two graphs over here. We've got the underlying market here. This is the S&P 500 over this time period. We've got the 2002-3 lows here. We've got the 2008 lows here, and then we've got the current bull market that we've seen since then and the October decline in prices. We can see that the trading strategy has mirrored in certain parts the underlying market, particularly when it goes off on a tear and has a nice strong move in one direction or the other, and we get a nice spike. The leverage that I'm using in this strategy to test it is 1-to-1, so this could be simulating a fully invested strategy. And we can see that from our starting point here, using a notional $100,000 of capital, that we've increased this at a greater rate than the underlying index has increased at this time. You can see here that we haven't really got many trades in this strategy at all because we've fully invested and it's taken quite a large deviation from the price. So we're going to ride out a lot of the small movements in the opposite direction. We can play around with this a bit. We can look at the effects of increasing the leverage. So if you wanted to use some leverage instrument, we can double it here. And we can see we have an increase in price, but of course the more we go up, we can see that there's also dangers to leverage as well. In particular, we can see this max drawdown. If this is all our capital and we're experiencing a 75% drawdown, most people are going to be pretty concerned at that point. Eventually we're going to increase the leverage and we're going to run into problems, of course. So I'm going to put it back to 1. The other thing we can do is we can make the strategy long only. If you want to only trade in the long direction, that's another way of doing it. Profits are, in this example, slightly lower. However, we are not getting the same downturns that we get here. We get some flat periods. We're not getting these same downturns. So it is an interesting option for some people. Depends on your risk tolerance level. I'll take that off for now. And the other thing we can do as well is we can change this ratio. If we wanted to make it very much more significant, we can look at say 20% or even 25%, and the number of trade goes considerably down. So we're looking for the market will stay long or short unless we have 25% deviation in the opposite direction, which doesn't happen too often. Okay, so I'm going to just set it back to the initial settings. Okay, so this has been an example, very simple strategy. All we're doing is looking for a deviation, a movement from close to close of greater than 10% in this example before we change direction, at which point we close and open the positions in the opposite direction. If you'd like more information about using Excel to backtest trading strategies, about the financial markets, economics in the financial markets in general, please go to www.tradeinformed.com.